Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we're going to jump right back in. I've got a lot I want to cover with you today, hopefully help you, in particular in these volatile times. This is an area where I want you to understand you have alternatives, ways to minimize risk and volatility in your overall investment plan. One of the big ways of doing that is through potentially through annuities. Now, there are different kinds of annuities, different types of annuities. And this is where, again, it's real important to understand not all annuities are going to accomplish this goal that we're talking about. So we want to talk about the different ones. They may fit other needs, but which need we're talking about is how to enhance your returns while minimizing risk or reducing risk in your portfolio, as well as how to provide income, needed income in retirement. You know, one of the things, if set up properly and you've got an annuity that you can pull income from, that allows you to leave money in the market alone, right? So it can ride out that volatility and you don't get hurt by that sequence of returns risk I talked about earlier. All right, so the four types of annuity. The first one is that of an immediate annuity. Now, an immediate annuity, basically you're just, you know, it's the annuitization one as an example. You're just going to give them, the insurance company, a certain amount of money, you know, whatever it might be. They're going to say, okay, we can give you this amount of income for that amount of money. And you can take that immediate income, that immediate annuity, and you can have now guaranteed lifetime income for your, you know, for your life, for you and your spouse's life. So this is one way. Now, you can also, sometimes we'll use these because we can do guaranteed income on the short term. We might have it just pay out for, say, 3 to 5 years. And that gives us the ability to take some money, get a little earnings on it while it's paying out, say for a 5-year period, and while we let other monies accumulate. I mentioned about a ladder. We can take this as being the base of the ladder, and then the next one up is a deferred annuity that grows for 5 years and then gives us an even higher income than the first stream. And then that goes for 5 years and goes into another one that deferred for 10 and gives us, and this is a way basically to step up your income over your lifetime using an annuity ladder. So that's just one of many strategies, utilizing a mix of annuities, if you will. Next, we have fixed annuities. Now, fixed annuities are basically sort of like CDs in a sense, or at least they have similarities. And by that, just like you've got a guaranteed period of, a guaranteed interest for a specified period of time, and at the end of that time, you can either renew it if you like the new rates, or you can just take your money out and do something else with it. So this is where, and again, one of the differences, fixed annuities again grow on a tax-deferred basis, so you don't pay tax until you take it out. Interest rates typically are a little higher on annuities than you're going to find on CDs. Right now, for instance, I think if you look at 2 to 3 year terms, you're somewhere right now at about 2 to 2.25%, I think, percent. And if you're looking at, say, 3 to 5 years, you can find them up 3% plus. So this is something to keep in mind. And as interest rates go up, they may become even more attractive down the road. All right, then we have variable annuities. All right, now with variable annuities, that's kind of tied to the market, or it basically is. You have sub-accounts that are sort of like mutual funds. Many of them have the same names and even money managers and that. These variable annuities, however, have higher fees. So basically, it's like investing in the market with higher fees. Now, you may have, you know, there's some riders or some different things in there that you may find these appealing. Personally, I typically avoid them, mainly, as I said, because of the higher fees associated with them. Fixed index annuities. Now, these are the ones that I use probably the most. Fixed index annuities protect your principal in a down market while providing some opportunity for growth. Guaranteed protection with growth potential. So one of the things with fixed index annuities is I was sharing with the Athene product in the different indices. So it used to be they just were tied to like the S&P 500 index. Then they started expanding out to the Dow Jones, the Russell 2000 and others. And now we have all these banks, Bank of America, Citibank, Barclays, that have gotten into the business of helping bring indexes that they've researched to give you more opportunity at lower cost, and these are in lower volatility at bigger cost, and these are then partnered up. These banks are partnered up with insurance companies to provide these products to you. So Athene, I mentioned the Citibank, the Wisdom Tree, the Schiller Cape. Robert Schiller won the Nobel Prize back in 2013 in economics for his equity research, developed the Schiller Cape Index. Smart guy. This has been a very good performer, the Schiller Index. The Citibank looks really good as well. That's newer than the others. And the Wisdom Tree. A lot of time, and you can combine them. You can put, you know, two or three or more indices together in a given product through Athene in that particular situation. Now again, not all of these are going to be available to everyone you talk to, and different, you know, advisors might have different favorites. The key here is finding the right product for you. Out of, I think, about 1,000 different products out there, narrowing that down, and some keys on that I'm going to get into as we get into this report from Nationwide Retirement Institute, is that we're going, and by the way, in future weeks, I'm going to get into some advanced concept with annuities. Today we're just covering some basics, but I want to get into advanced concepts, talking about how you can utilize annuities in tax planning, in IRAs, in trust planning, estate planning, so some advanced concepts of how they can be used as well. Now, coming back to this, so I can get all your material in, or try to get this all in for you so you can learn more about those basics. Why choose an annuity at all? I mentioned to you one piece being that of the plugging it into a portfolio in place of some bonds as a way to reduce risk and enhance returns. Another, personal, so again, determining which one. This is the 4 Ps according to Nationwide. Personalize it, finding help meet your goals with the right product. Propel, possibilities for growth, tax-deferred, growth potential, income, legacy, spousal opportunities, and protect. This is one of the keys. Protect what you need most. We think of life insurance as an example, as a way to, protect against dying early, to protect your family. Annuities are kind of like insurance to help protect against running out of money. Okay, that's one. It's like insuring your income, if you will. So that's one use for them, one way to look at that. Another is they can also provide, some of them will have long-term care features or benefits. So if you had need of a long-term care, and to give you an example, Allianz has a product, for instance. This one has and there are some other companies that do as well, similar to this. But basically the way it works, if you go into let's say you're taking income, now it's meant to stay in deferral for 10 years and then provide you guaranteed income for life, and that income to increase over your lifetime through the performance of the, what they call the BUDB, the Barclays Dynamic Balance Index. This is one. Okay, one product, and again, there's others that have similar benefits such as this. But what it's going to do is it's going to provide you that income. The income, should go up over your lifetime as well, increase. And if you died early, okay, and there's any money left in your account, it's going to, of course, pay out, and it'll pay out an enhanced death benefit. So it'll actually give you a greater amount to your beneficiaries, or they'll have the option. They could take a lump sum for a smaller amount, or they could take a greater amount over a 5-year period. Usually works out to their best interest to do so. Then if you're taking this income and you had a long-term care event, you need to go in assisted living, you couldn't meet, I think it's 2 of the daily activities of the 5 daily activities for living. If you couldn't meet those, then it will double your payment for 5 years to help you cover that long-term care need. So that's a great benefit. There are others, like I said, that have it. Let's go back to immediate annuities then. Okay, so but you can see there's a lot of different product, a lot of different features and benefits, how to find the right one to fit your needs depending on what your goal, whether it's to enhance growth, to reduce risk, increase income, whatever it might be. So when we look again at immediate annuities, most basic type of annuity, lump sum contribution, one time, and then converted into an ongoing guaranteed stream of income. You can have it again for as little as 5 years up to lifetime. And then the key with that is your one immediate is that you have to start taking income within a year. All right. The benefits, tax advantages, immediate payments, customized guaranteed income, income security, additional features for added protection, inflation riders, a bunch of different things that are available out there. Again, what should you consider before buying? It's not for everyone, and options matter. Immediate annuities, by the way, do offer, as I mentioned, an inflation or cost of living feature. Now let's look at fixed annuities. I'm going to crank through these kind of fast because they're pretty simple and basic, and I want to spend a little more time on in particular on the fixed index annuity side. So on fixed annuities, again, you're locking in a rate of earning. You're getting a guaranteed rate that you're going to get paid, unaffected by market up and down. Your guarantee is it for the life of the contract. Principal, investment, and rate are guaranteed. So if you're looking for a guaranteed interest rate, you don't want market participation, minimal investment risk, but still a chance to grow, fixed annuity would be a good fit for you. All right, what are the benefits again? Tax deferral, principal and interest protection, no market risk, flexibility, lower investment minimums, beneficiary protection. This, by the way, with the benefit with annuities, another nice feature is that if you pass, the monies go directly to the beneficiary. There's no probate or no delays. So this can also play into your estate planning, how you can use these for that. What should you consider before purchasing? Less opportunity for growth, inconsistent rates. Okay, the interest rate market, we see what that's like. Interest may not keep up with inflation, and that's one of the keys. So even as we see interest rates going up, and they're not going up as fast as inflation and the price of the goods and services we're buying. So, fixed index annuity. And when we look historically, by the way, and I've shared it with the three worlds with you before, historically the market has helped people keep ahead of inflation and taxes when properly invested. Fixed index annuities can help do that as well, and variable annuities, again, higher costs reduce your return, but they could also help you stay ahead of inflation and taxes. Fixed index annuities, the right ones, when you look at their historical returns, have done the same, much as what Ibbotson talked about, Kay, and ahead of bonds. Some of them have enhanced returns sufficient to, again, stay ahead of inflation. When used in an overall plan where you're having a lot of different things, like investing in the market as well, that can enhance your benefits even further. All right, fixed index annuities. These are the ones that, as I said, I use the most. They're the ones that I think give you the most benefit. Principal protection in a down market and opportunity for growth. So when the market goes down, your principal, the amount you invested, is protected. And more growth potential than a fixed annuity, less risk and less potential return than a variable annuity. There's less risk and less potential. Yes, maybe the high fees are again a trade-off, so you'd want to look at the different products. That's a little too broad a statement for me, because one of the things I look at is I find that some of the better fixed index annuities, in particular, you could be comparing a very poor variable with really high fees to the fixed, and the fixed would be better. So make sure you're really knowing all the trade-offs, if you will, to get the right product for you. Returns are based on the changes in a securities index, though you're never directly invested in the index, right? Your returns are tied to it. Want a chance for upside gains in a good market, protection. So what are the benefits of a fixed index annuity? Tax deferral, principal protection, lifetime income, investment flexibility, earnings credited, beneficiary protected, spousal opportunities. When it comes to these, one of the things that you get into with choosing your indices is that growth, and depending on the product, every 1 year, 2 year, 3 year, they will lock in your gains. So for instance, the Athene product I just talked to you about with the different indices, that one locks in gains every 2 years. And there's a lot of advantages that can go with that, not just that you're locking in your gains. And when I say it locks them in, that means, let's say you put, I don't know, $250,000 into an annuity, and then 2 years, into that particular one, 2 years later, it's let's say it added 10%, just pulling a number out, $25,000 gets added. Now your $250 is now $275. There's actually some compounding, so it'd be a little greater than that. But that 275 now becomes your minimum guarantee. Can't go below that. Every 2 years you're locking in gains and you're raising then at the same time the minimum guarantee. Now there are years you can have a period where you get a zero. Say the market's going down, you know, zero may be your hero at that point because you're not losing anything in a big downturn. So something else to consider. More to cover there right after this break. Join me here. We'll be right back on the Retirement Report.
Time has come to enjoy your golden years, but have you saved enough?
I'm Hank Parrott.